the progression and evolution of stockbrokers. When people hear stockbrokers, they think of 1980s Wall Street, or even the movie Wall Street, Boiler Room, Wolf of Wall Street, things like that. That's not the case any longer. But it was years ago. Before my time, 1980s and even before, 1990s and before, really, stockbrokers were stockbrokers. They would buy individual stocks on behalf of their clients, and more often than not, churn them and burn them, because they were commission only. You eat what you kill. So they would buy individual stocks. Hopefully the price will run up and then sell them and charge big commissions for each trade. Now, a lot of them were legit. A lot of them made money for their clients. As I mentioned in previous videos, my mentor was a stockbroker in Detroit, downtown Detroit. For many, many years, he started way before I was born. And he made a lot of money for his clients, and he charged a lot of commission and made a lot of money for himself. And he ended up retiring a multi-millionaire. Back then, they used to call placing a trade or buying a stock dropping a ticket. You'd actually write the order ticket, send it in a little air funnel, like when you're a drive-through for a bank. You'd send it up to your back office, usually the floor above you, in a little tube with the order. Then the secretary in the back office would call New York and place the trade. Now it's instantaneous. It's not like that any longer. But that's how it was really, and really some people still do that, not trade that way, but charge 100% commission or majority commission for their clients and make money on the trades. But the hardcore commission, that was really popular up until maybe the mid-late 90s. So then you get to the late 90s and you start seeing firms like E-Trade come up where people can trade on their own. But remember, it was still trading. That was a thing. There were still trading stocks. And then you had more people turn to being financial advisors, not just stock jockeys, not just buying and selling a stock, but putting together portfolios, which is what they do today, the very vast majority of them. So you saw people, see, once E-Trade came up and all these online brokerages or discount brokerages, stockbrokers needed to flip their business a bit and become all-encompassing financial advisors. So what they do is they basically put together mutual funds. They'd still get commission on them, but mutual funds pay trails, meaning you get a commission every month from your clients' accounts. And or you'd put a wrap fee on them. So you'd charge your client 1, 2. I've even had coworkers when I was at Merrill charging 3% a year for a group of mutual funds. They'd have a wrap fee around these mutual funds. They'd charge 3%. Most clients don't even know what they're paying nowadays. But I guarantee you, if you look, you're paying much more than you should be. So financial advisors were doing that, charging wrap fees, selling mutual funds. But then we get into the ETF boom, which I started seeing became more popular in the early 2000s. And the ETFs are just indexing the market. So then financial advisors put fees around that. They'd put a basket of indexes that were very, very cheap to buy. Maybe 3-4 basis points, 10, 30. Anyway, they were much cheaper than what mutual funds were charging. And they just index a market. They'd follow the index. So financial advisors would put a fee around that. And what's popular now is usually around 1%. That's pretty much a fair fee. But generally, a lot, and I mean the majority, are still charging 1.5%. 1.5% to manage. And that's basically the majority of financial advisors now. They're charging a fee. They have index funds, maybe a couple of no-load mutual funds, and they're charging an ongoing fee. But the problem starts because these financial advisors, they have to take on hundreds and hundreds, if not over 1,000 clients. A lot of advisors, these guys that have been with it 30, 40 years, they're managing over $100 million. And I guarantee you it's not $1 million per client. They have hundreds and hundreds of clients. How can you manage so many clients and give individual service to all these families? Well, the answer is you can't. When I was a bank advisor, I had almost 800 clients. And that ranged from $10,000 up to $1 million. And I wasn't giving them individual service. I couldn't. I had sales goals. I had to sell upfront front-loaded mutual funds and insurance to hit my goals. So financial advisors are starting to adjust even a little bit more. They're going independent, RIA, which is what I owned for roughly 7 years, where you don't have sales goals. You don't have to really churn and burn. That generally doesn't eliminate, but it takes the pressure or the incentive away from churning your clients. So they're charging what you see a lot of advisors, 1% a year. They manage your portfolio. They answer the questions you may have. They answer their phone. You have their cell phone number. It's an individual RIA, registered investment advisor. It's an individual advisor or it's small team that's managing your family's finances. So there's another problem that comes up though. If you get paid AUM, assets under management, if you're getting paid for how much money you manage, well, what if your client has 50 or 100 grand in cash at a bank? What if your client has a duplex or 2 or 10? You're incentivized to say, hey, sell that duplex, put it with me in the market. Don't keep cash here, put it in the market. You need to get more assets under management. So that's similar to the old churning problem we had with stockbrokers. So what are financial advisors going to do if they want to be honest and give the best service to a small group of families? Which really, to give real personal service and advice, having over 100 clients, hell, having over 50 clients is going to be difficult. You're not going to be giving them individual service and advice. Really, let's face it, you're not, especially if you have over 100 clients. That's not going to happen. So what are advisors doing now? What a lot of people are doing is going to a flat fee only advisory platform. Not necessarily platform, but way they're managing money on their platform. So what is this? I think this is one of the final evolutions of financial advisors. It's basically this. I charge you a flat fee. You have $1 million. It's 12 grand a year. I manage everything. You could have 100 grand in index funds with me, but 10 rental properties, but $1 million in cash, but an IRA for your son or a 529 for your son. It doesn't matter. It's just your net worth. You charge an annual or monthly fee based on that net worth, something that is fair. Usually it would be under 1% of their net worth or right around there. But it disincentivizes you to say, hey, sell that house and put the money with me. It makes it clear that you can do the best thing for the client. Now, a lot of people, they might be with a big expensive broker at Merrill or Morgan and think that's the best because it's the best name. And really, there's no getting through to those people. But I really think the best and most efficient way to manage a family's net worth as a financial advisor is a flat fee only advisory service. So they can have $250,000 in cash at their local bank. They can have 10 rental properties. It doesn't matter. You're charging them a flat, ongoing service fee to give solid advice and answer their questions about their investments, about the market, about the economy. Now, as a financial advisor, you better know what you're talking about if you're doing that. If they have real estate, you better have some knowledge in real estate. If they have general questions, you better know what's going on with the Fed, with the economy, with the market. But like I said, this is the latest evolution of financial advisors, the flat fee only model. So what model are you guys using? What model is your financial advisor using? And if you look at how much you're paying in fees, I bet you it's over 1% a year, which is kind of getting into the danger zone where you're cutting into a lot of your profits. I hope you enjoyed the evolution of financial advisors. Remember, this is not financial advice. These are just my thoughts. Don't forget to like, share, and subscribe. Let me know what you guys think. Thanks.